Very good evening to you traders, Mark here from the day trading room. Okay, quick video tonight. I've not talked about these before. The hit and run trade. Right, there are just basic rules for this type of trade, and it's one of these that don't happen very often, but when they do, they are very nice to get. They're very nice because you get your profit quickly, you're in, you're out, and it's exactly as it says, it's a hit and run. Okay, you're taking the trade, you ride the momentum, you don't care what's going on, you're just basically trading on pure price action. Okay, the rules of the trade are this, and these should be part of your global plan. By the way, you don't plan for these, you don't know when it's going to come out. It's all based on some unusual news, whether it's stock specific, market specific, country specific, whatever it may be, something that comes out during the market hours that's going to change the perceived value of that market, a reprice type situation. Hit and run, you're in, you ride the momentum, you take your profits, you get off, you don't look for any home runs, and you definitely don't give it any room. And that is the number one key. I always talk about this, but it's so key. Risk management. Okay, so important. So in this situation here, this was it. This is the example I took. My average entry was 55. Yeah, it looks bad on the chart, but that was the time that I identified the momentum was serious. That was my average entry, and my average exit was 16,000. So it's 45 ticks, and it took just over 30 seconds for that trade. Nice. You know, these are the nice sort of trades that you get from time to time if you're prepared. If you're not prepared for it, it lasted less than a few minutes, you missed it. If you happen to be at the screen and you're prepared, you get it, you get 45 ticks in your pocket, you move on, you wait for you trade the rest of your day's plan. Number one is definitely risk management. Number two is quick and speed. You are looking to get on the momentum. If it's pushing up, you can just see that tape, the green coming through the time and sales. Bids stepping up, offers being hit, and being pulled higher up as well. Important to see that on the market depth. You look at the market depth and you see higher up the ladder, like position 5, 6 and 7 being pulled, going down as people see the market running up to them and not really wanting it. So you get liquidity drying up from here upwards. You get liquidity building up on here as people are missing their order, missing their fills. They're adding their orders here. Imagine that's the market depth. Adding them, market's moving away, so liquidity fills up there. Liquidity pulls away from here. Natural magnet is the market to push up. Okay, so you've got to manage your risk. Number one, we talked about that. Then what I mean by risk management, basically you put a stop in and you stick to it. This thing should work straight away. It's a momentum trade. It's not looking at key levels. It's not anything else but pure price action based on that 1-2 minute period. Nothing else. That's the premise of the trade. As soon as that momentum stops, you're out of there. If that happens to be 3 ticks from your entry, that happens to be 3 ticks from your entry. If it happens to be 100 ticks from your entry, it's 100 ticks from your entry. If it stops after you've got in and rotates on you, you're out straight away. You're not being clever with this. You're in, you're out. It's a pure price action momentum trade. 2, quick. Exactly that. You're in, you identify, you take the trade, you're all in, you're all out. Not looking to be clever, not looking to run anything, not looking to scan for what the news is. This happened to be something about one of the Fed guys saying something to do with QE, gonna be keeping it on for longer, whatever, who cares, it doesn't matter. All you're focused on at that moment in time is making some money from that move, and it's a quick in and out move. So risk management, number one, 2, quick. And number 3, once you've done it, step away. Because your adrenaline, I don't care, is going to be, you're going to be in a heightened state of emotion at that point. You know, experienced trader or not, you've seen something happen, you've zoned into it, you're focused, you're watching that tape, you're watching that volume flowing, you've taken the trade, it's taken you 30 odd seconds and you've made 45 ticks, whatever it may be. Step back, you know, step back from the trade, you know, let the mouse go, push the mouse away, and just review the situation. What's happened, make some sense of it. And you can see why, because if you're then looking, you know, that trade example there, the 55 out of 16,000, if I saw it coming back here and thought, oh, I'm going to look for a further push up without really thinking it, without really examining it, I'm going to get my head taken off as it just comes plowing back down. And that's exactly why you're quick here as well, because you want to be out at this point. You don't want to be being clever and trying to finesse it and saying, oh, I'm going to draw a fib here, I'm going to do this, I'm going to do that. Forget all about that. Momentum trade, price action, tape reading. As soon as it pauses, and for me that was at 16,000, I know it looks like it was a perfect, it looked like it was a premeditated exit because it was the high. I assure you it wasn't. I was literally just looking at the tape and it happened to pause there, and but as it was the high, it was a coincidence that people weren't looking at get involved at that point. It went on further. Yeah, do I care? No. I'm in, I'm out, I'm quick. And risk management, and it's a great example as why you need to use that risk management, because if you don't and you're chasing up here and you're not quick enough to get out here, if you don't read it correctly, it happens. It's not a bad thing. It happens all the time, losing trades and not reading it, or being a bit late to the game, especially in this momentum trade. Being late, you know, you're making an assumption that when you're in it, it's going to carry on. If it doesn't matter as long as you ditch it. It does matter if you're buying up here and then it just rolls over and just rips your face clean off because you're not coming out quickly. You've got to be quick, and if you're not quick on this and you're not comfortable with it, and you're not comfortable with managing the risk and using the stop and getting out if it's not going your direction, when this happens, your plan should be to step aside. But if you feel comfortable with it, if you feel that you're comfortable taking the trade, you're comfortable with the risk, you're comfortable with quick execution, and you're comfortable with your tape reading skills, and this is a nice little trade that comes along every now and then, a handful of times. And if you're there and you happen to be in front of the screen, it'll be a crime not to take it. Anyway, that was a quick video, guys. Have a great week. Keep the risk managed. Really looking forward to next week. Some good action coming up, good earnings, good movements across the board. Let's have a really good one. Take care.